welcome everyone to Blockchain Professionals September 2021. I'm here with Kaya, Maya Stewart, our new co-organizer, Shane Brunette from CryptoTaxCalculator, and Harrison Dell from Chamberlain Lawyers, I think. We are here today to talk about crypto tax, which is very timely because our tax returns are due next month. This is mostly geared towards Australian tax, but I assume there will be some things that can be taken as, you know, wherever you are in the world. Just be mindful and do the right thing. That's the main message. This is not legal or financial advice, but you know, just take the takeaways are for you to use, and I'm having a blank right now. The takeaways are here for you to use and you know, do the best that you can when you're doing your taxes this year and moving forward. Welcome everybody to this stream. It's good that you're here. Unfortunately, we can see you, but we are willing and wanting to have your questions on the stream. Send them through. We're gonna have a Q&A at the end. Kaya will be moderating those. So welcome, and I'm gonna let you all do your introductions. Kaya, let's start with you.
Thanks, Adri. You made it really easy. Hi, everyone. I'm really thrilled to be learning about my crypto tax obligations and how to make it easier. I can see that there's quite a few people here that are in the same boat. I'm Kaya Meyer-Stewart, co-organizing these events from now on. And I'm a product manager who likes blockchain. That's who I am. Shane, who are you?
Yes, I'm a software engineer, fan of CryptoTaxCalculator back in 2018. After we were going through a bear market, post-ICO boom, had my own crypto tax nightmare, I suppose, and so did a lot of my peers. Yeah, so I kind of thought, you know, I'd sort it out with a script, put it together over a 3-day weekend kind of thing. Thought it'd be done, and I'm still here 3.5 years later, about a team of 20, Australian-based, supporting about 40,000 users at the moment. So yeah, it's been pretty busy.
Very cool. Harrison, who are you?
Who am I? So I am a tax lawyer. That's the main thing I do. A large part of the work I'm doing these days is on cryptocurrency tax issues. And that's something that I've even publicly put on the website as something I now specialize in. It takes up a lot of my time, and I really enjoy it. And my first interaction with crypto, and particularly crypto tax issues, was when I was at the ATO. I was part of the tax council team that were dealing with the cryptocurrency tax issues. So we've got some stuff out there from the ATO saying that crypto is taxable, and that upset a great many people. And since then, I've been telling people all about that on repeat. And me and Shane have been working very closely together to resolve a lot of issues. As you're soon to see, there are a lot of questions in this space. We could be here for days and just keep going. So yeah, that's me.
Awesome. So let's get this show on the road. Harrison, I think you're going to share your screen, and we're going to have some slides to look at. And after this joint presentation with Harrison and Dell, Harrison and Shane will do a demo of his current product, the CryptoTaxCalculator. Let's kick it off.
All right. Sharing my screen, pressing the go button, closing my door so the cat does not break in. All regular work from home things. But yes, as discussed, we're going to talk about cryptocurrency, and particularly on the tax issues, of which there are numerous, and which the questions and new things developed in this space never end. So therefore the tax issues will also never end. So I'm Harrison Dell. Shane is the one with the slightly longer beard, although we are racing each other. So what we're going to go through today, we're going to go through the most core tax, which is capital gains tax, is the tax that's going to be affecting most people in this space. Number 2, talking about trading crypto as a business, which is going to affect the people who don't get hit by number 1. How CGT really works in the crypto space, some new developments in the past sort of 3 or 4 years in regards to staking and airdrops, which have become more and more mainstream. The DeFi stuff we talk about as well, staking contracts, liquidity pools, BlockFi, and those alternative products as well, and kind of how that causes some very strange CGT issues. We'll talk about mining a bit, although mining is not quite as big as it used to be. We're going to be talking about bridging contracts, which present very strange issues, and wrapping up with some stuff about self-managed super funds, which I'm sure it's shocked a great many people that we can now invest our SMSFs into cryptocurrency. All right, let's kick off. Talk about the basic building blocks of tax in this space, and that is capital gains tax. Before I even jump into this slide, something that people often don't understand is that capital gains tax is not a tax. And you can bring that one out at parties. It's a great bit of trivia. It's not a tax. What it does is a set of rules that says this amount is income, and you then pay income tax according to your marginal rate. That's what you got to keep in mind. That's the end result of what it does. Now let's go back the other way and figure out how this stuff all works. So for CGT to apply, and I've given this presentation many times, this is my favorite bit, talking about CGT. You need two things. You need a CGT asset and you need a CGT event. If you don't have both of those, CGT doesn't ever really apply. There's a couple of exceptions, but they're very rare cases. What is a CGT asset? I'm glad you asked. It's basically anything. Everything is a CGT asset. The only known exemption from this is pure information, such as it's sunny at my house today. That is not a CGT asset. However, if I wrote it down on a bit of paper and then mailed it to you, that piece of paper would be a CGT asset. It's a very strange thing but you need to understand that as a very basic sense of what it is, and it's basically everything. But then when you start talking about cryptocurrency, the ATO has a view out there, which is undoubtedly correct, that cryptocurrency is an asset. It's a thing that has value, and things can include intangible rights. The example I always give is when you get on the bus. I'm in Sydney, so I'll talk about it from a Sydney perspective. You tap your Opal card, you've then acquired a right to ride the bus. You've acquired a CGT asset. That is something that CGT would apply for. Now it's personal use, so we don't worry about it, but it's the same thinking. You know, what have you got when you've got a cryptocurrency asset? That's a very strange question, which we're going to come back to. CGT events. So there's 54 CGT events, but there's really only one you need to worry about in this space, which is CGT event A1, which is when you dispose of a CGT asset. That's by far the most common event. If anyone has one of the L events, which relates to tax consolidation issues and things like that, and they're talking cryptocurrency, you've got really big problems. But for most of you, it's going to be A1. When and how to report CGT. Now, Shane, I want to throw to you for this one, because this is the stuff that you get in the weeds with.
Yeah, so I mean, you're meant to be reporting every year when it comes to, if you want to end of financial year, you're meant to get your tax reports all together, all your bookkeeping up to date, and then you're able to generate the capital gains report into like using some sort of software. If you're going to use a pen and paper, you can sort it out that way, but it's essentially meant to be every year. If you've been disposing of capital gains, you've got to kind of record that. And also the ATO has got a lot of kind of record keeping requirements around the transactions as well, even if you're not disposing of the asset.
Yeah, exactly right. I believe it's 5 years you have to keep the records for, and that's 5 years after the CGT event. So while you're owning the crypto or any other asset, you've got to keep those records indefinitely. People have been tripped up on that before, but what's good to remember, and a big part of what Shane does and CryptoTaxCalculator does, is you have to look at each individual CGT asset to work out the event and the gain and the loss and things like that, which we'll talk about in a moment. So it's about every single item of crypto, and then that gets pretty complicated. Shane, I've seen my own report and it was not very nice to look at.
Yeah, I mean, the real complication is with crypto, often, you move into the crypto ecosystem with, say, Australian dollars. You might move out of it where you cash out with Australian dollars. The first thing where people get stuck here is, the crypto to crypto transactions. That's actually a disposal of crypto for another crypto. And I think we're going to dig into that more, but that's obviously got its So all of a sudden you don't have a reference price for, Australian dollars because you're trading between cryptocurrencies. But then on top of it, there's all types of financial instruments, but you can have like a third currency here, which might be the fee, might be in a third currency itself. So it can quickly evolve into kind of can of worms, I suppose.
Yeah, it's absolutely like really simple at its when you go, yep, it's an asset, it's an event, it's a gain or a loss, but actually getting it right without some software to help you is extremely difficult. I've seen accountants try and attempt it, and it doesn't end well for their sanity, I found. Anyway, moving on, because we've got lots to get through. The CGT discount. So the 50% CGT discount applies to individuals and to trusts if the beneficiary of the trust is an individual. A company does not get the discount at all. However, a company will get a flat tax rate of either 30% or now 25%. So sometimes companies are good. And superannuation funds receive a 33% CGT discount. I should have just called it the discount, not 50%, but the 33% discount reflects the fact that superannuation funds have a lower income tax rate of 15%, something like that. I'm not that big on SMSFs. I'm more big on the tax. Let's move on. So when we apply it to crypto, we have the exact same thought pattern that we have for any other kind of asset. The reason why crypto is a problem in this space is because there are not very many other assets that you can swap asset for asset without liquidating to cash and then rebuying. For example, I can't trade my BHP shares for Woolies shares. There's so many things that you can do with crypto that you can't do with other asset classes, which has caused a lot of these complications. So the most common CGT event, as I said, was A1, selling it on an exchange or gifting it to another family member. The key thing to remember is, are we changing the beneficial ownership? If I'm giving some crypto to Shane and saying that's yours, that's a change of beneficial ownership, which is what you've got to be thinking about. If we're converting it to fiat currency, I mean, some people hate when we say fiat, but it's what we need to say now to describe this space. That's a sale event. That's also a CGT event, A1. When you convert it to AUD, USD, whatever. One that people get stuck on, I answered this question 3 times this morning. Converting one crypto to another is a sale event, because if you have 2 cryptos, if I change my Bitcoin for Ethereum, there is basically a price that's reflective of USD. And when I exchange them, it's reflecting kind of that value. So I'm selling my Bitcoin and receiving an amount of Ethereum. The market value of that Ethereum will be your capital gain or loss based on what you bought your Bitcoin for, which is kind of mind-boggling for a lot of people, unfortunately. But we're getting there. We're making good progress in this space. Shane and I are crusaders for knowledge here, I think. And the last one, which is not coming up so much, but buying goods and services with your crypto. I know of a barista who accepts Bitcoin for coffee, and he's so far accumulated 0.8 Bitcoins. And whenever they bought the Bitcoins, you've got to think of, well, each person buying it had a CGT event. There's also GST considerations and things like that. We're not really going to get into that here too much. But CGT is basically always going to apply whenever you deal with this asset. As we sort of spoke about before, actually tracking each individual coin, token, transaction, gas fees, dates of acquisition, first in, first out, which crypto am I actually selling if I bought a whole heap? These questions are still kind of out there and we don't have the answers. Shane has asked me an awful lot of questions in this space, and I've been doing my best. But actually tracking what's going on is harder than it may seem. Would you agree with that, Shane?
Yeah, look, that's the problem that we're out to solve. It's really just a data warehousing issue. Like, we've got to pull in all the blockchain data from every single L1 or L2 kind of blockchain and aggregate it all. And that's really how you do it. You've got a universal view of all transactions. Obviously, the exchanges, because the centralized exchanges, they've got their own data dump, and you require the user to import that data. But essentially, once you've... An important thing around here is the tracking side of things. Something to be mindful of is that people think that, if they're transacting on the blockchain, it's anonymous. and it's not, it's pseudo anonymous, and there's a very clear link that's publicly visible. You can, I mean, that's what the blockchain does. There's a clear link between transactions. And so as soon as there's, you know, that link between the exchange to the blockchain, you can kind of, you've got a very clear audit trail, I suppose, that's publicly visible. And therefore, as long as the blockchain continues to run. Yeah. So from a compliance perspective, I think it's catching up, I suppose.
Yeah, absolutely. And yeah, I only occasionally see people now really keen on the privacy aspect. And I say to people, if you've ever used any KYC function with any crypto exchange in the world, if you've used any Australian-based exchange, if you've used any on-ramp that collects KYC data, and then you've transferred that to one of your wallets, the ATO probably knows about it. Because they've got data matching programs. It's all public. The KYC stuff is swapped pretty easily. Thinking that it's anonymous, it's no longer what crypto is for. It used to be kind of for that, but now it's progressed and it's got so much scrutiny that's pretty much lost. So yeah, it's pretty easy to see what you've been up to, and that's part of what CryptoTaxCalculator does. It gets that information and puts it in a format which makes sense for tax professionals like me and accountants. Well, let's move on. We're going to run out of time. I told you this would go. There's a lot to talk about here. So CGT applies if you're an investor. So if you're just buying, holding coins, maybe doing a few other things, you're just an investor. CGT is the main thing. For everyone else who's not an investor, if they're taking it a bit more seriously, if they're doing kind of like day trading or swing trading, or they're quite sophisticated, using a lot of capital, you may be carrying on a business of crypto trading or liquidity farming or whatever it is exactly that you're doing. So what is carrying on a business? It's the same test as with anyone else carrying on a business. It's about, am I doing it for commercial reasons, or is it actually viable? Am I going to make any money? Is it just a hobby? Most cases, if we're investing in crypto and blockchain, we're here to make money. I, for one, don't do it for benevolent purposes. I do it to make lots of money. Acting in a business-like manner. Do you keep records? Do you have a strategy? Do you have staff? How many hours a day do you spend? Do you have target profit? I know traders have a 1% to 3% target profit per day. That kind of thing, and being a bit more systematic, is more of a business-like manner than just buying coins and holding them, which is a great strategy, I might say. But also trading itself can yield different, sometimes better results. If you're preparing accounting records, if you market to the business, in this space, no one's really going to market to the business, although there are some people that run liquidity mining services where they will do things for you. There's a bit of question mark there about who's running the business in that case. Whether you actually intend to make a profit or if you're just doing it for fun. And this is a big question in the mining space, which we'll come back to later. If you're not really going to make a profit, if you're just going to make losses and it's to have a good time, such as if you're playing a crypto game and earning some tokens and that's what you're doing, it's not really going to be a business. It's just going to be a hobby. And some sort of repetition and regularity is also a strong indicator, but it is not required. All of these are merely indicators. And this question has been haunting tax specialists for like 150 years. And cryptos has made it even harder. So some more indicators, particularly for crypto and trading, is if you're taking your profits regularly, if you've got that strategy, detailed records, frequency, significant capital, although low capital can still be a business, and registered spaces, research and analysis. Figuring this out is really difficult. There's a couple of private rulings out there which do help somewhat. And in recent conversations that Shane and I have had with the ATO is saying that they're going to be quite practical about it. So there used to be a bit of mischief in this space where people said they were carrying on a business to claim losses. This is around the time of the GFC. And the ATO scrutinized that quite a lot. They said they've kind of stopped doing that. So this is just more something you need to figure out yourself and just apply it consistently. Don't try and do something that your facts do not support. And your tax outcomes change very differently. So there's no 50% discount. Do I put this next slide? No, I'll talk about the good stuff first. So you can get some tax concessions. You can write stuff off, such as if you buy a computer, all sorts of things. You can claim losses on revenue accounts if you make significant losses. then you may be able to claim offset it against your salary and wages or other income. Although if you're making losses, you may not be in business. It's a bit of a funny question, that one. You go into the trading stock rules, which are a bit of a nightmare, to be honest. And there's no discount available. So there is no 50% discount for holding for 12 months. And if this is the kind of thing you're doing, you're probably not going to be holding for 12 months anyway. If you're going to do this activity, often it's recommended you use a company, because you can get a flat tax rate of 25 or 30% and get franking credits and things like that. And it's a different kind of system for how you look at it, isn't it, Shane? Especially with the trading stock rules in play.
Yeah, exactly. With the trading stock rules, it's a fairly unique reporting requirement. I haven't seen anything like it internationally. And you've got to have all the starting values and the ending values at the end of the year, and what you've purchased and sold throughout the year. So it could definitely change the calculations, I suppose, and what your actual end results are. I guess the key point here is the snapshots at the beginning and the end of the year,
Yep.
and how that can kind of influence your taxes.
Yeah. And look, there's a few concessions in this space, but if this is what you're doing, you need professional help to make sure you're doing it properly. Because this is not a new tax thing that you're running a business. You need to get an accountant to help you out in most cases. And they need to run this software and make sure that it's all working properly. So if you're just doing sort of what I've got here, if you're buying and selling, for cash and stable coins, reinvesting, you're not really taking profits. You're investing for the long term. 12 months is a good ballpark, but it can be sort of shorter than that as well. And not making many transactions, it's pretty likely that you're an investor. And the ATO kind of indicated that more than 1,000 transactions a year, you're at pretty high risk of being as carrying on a business. Less than that, you're probably fairly safe, unless you're, or it depends exactly what you're doing. But if you have any doubt, you need to get some advice. That's the thing. Changing from an investor to a business can be a bit of a problem too. You've got a very special CGT event. I said I'd only talk about one, but I'll talk about another one. It's called K4. It basically says that when you change from holding it as a capital asset, and CGT applies into the trading stock rules, you have a choice to apply a taxing point and get a higher value for the trading stock rules, or you have a choice not to. If you try and get that higher value, CGT will capture that gain. And it may be a good idea to take it, because if you can get the 50% discount, then that may be suitable. And I've seen people hold Bitcoin long term and then go, I've got squillions of dollars now. I want to just convert it into a business, take the CGT, and then do more day trading activities after that. Staking and airdrops. Conscious that we don't have heaps of time, let's run through it. Staking is earning reward, or staking takes a number of forms, but basically you put your crypto in a pool, you stake it somewhere, and you'll earn a reward. And the reward is usually because you're validating transactions on the blockchain. Airdrops are often you just hold a token, or you participated in something, or you did something a while ago and your wallet was selected, you get free tokens. So staking and airdrops are pretty common nowadays in the DeFi space, especially. It's a good way to get a token started, and it's a good way to get people to invest into your DeFi ecosystem. So there are some things out there, not officially from the ATO, but in some forums, things like that. What you receive from staking, when you get rewarded in more tokens, usually that amount is accessible income. So that amount is, even if you're in the CGT world, that amount is income. It's what we call income from property. And you derive that income, it's taxable when it's basically credited to your account. There are some crypto, I think it's Cardano, which has the 5-day epochs. You wouldn't derive it until each 5 days. Whereas I'm in PancakeSwap, I'm deriving cake, I think every couple of seconds, basically. Whenever it's basically credited to my account is when it's derived. Now, there are some which you have to lock it up for quite a long period of time. I think the longest one is Hex, which is 5,555 days. And you will still derive that income while it's locked up, because it's credited in a way as you direct. And people are going to make this mistake, and I will see an audit case for this, I have no doubt. People will be saying, I can't access it, therefore it's not income. That's not quite true. These coins are assessed, like say that you receive the coins worth $1, you pay tax on the $1, you've then acquired it for a $1 cost base. If you are in CGT land, which is most of us. Say I sell it straight away, I'll have no capital gain or loss. You're sweet. Say you sell it tomorrow, it's $1.50, you'll have a 50-cent capital gain because you hadn't held it for 12 months, no discount. That's it. If you hold it for a while, you may be able to get a discount on gains. So it's a kind of something to think about, is whether you're going to hold it long term or whether you're going to sell, and that's it. You've got to be aware of rug pulls, because when you receive the token, you'll pay tax on it, and say that token goes to zero, you've still got to pay tax when you received it. And it will catch people, and it probably has already caught people. I haven't seen any yet, but there were quite a few tokens out there where they had very, very high values, but you couldn't actually sell them. The ATO, when I kind of raised that issue with them, they did say that they would be practical. If there's no liquidity in a market, that's not really the market value. So if that's happened to you, you need to really sort that out, and make sure that you don't get stung with that, because the ATO, as I said before, they basically know everything about you. They're very keen to audit in this space. And I do expect audits to start from about November or December, because we're all going to be lodging by 31 October, unless we're with a tax agent. And the ATO will start having a look at things, I've no doubt, seeing as they've been very public in the media about it. Airdrops, they're not free coins. Just like staking, pretty much always going to be income. There are a couple of exceptions, such as if it's a hobby, but in most, if not all cases, it's going to be income based on the value you receive it. Airdrop coins aren't often worth that much, because airdrops usually happen at the start of a project, or to kind of kickstart a project, keep it going. They don't, you're not going to get airdropped Ethereum anytime soon, as much as we all want to. So they're not usually a huge problem, but you need to be aware that they do have a taxable value. So you, as before, you pay income tax. Say if it's worth $1, you pay the dollar as tax. It's then got a cost base of $1, and if you sold it immediately, that's what would happen. Actually tracking that's a bit of a pain, and I think Shane agrees with me there. It's not easy when you have lots of transactions, like say your own. I think it was SafeMoon we were talking about, Shane, where you get the reflections, which are kind of similar to airdrops in that you'll receive more tokens over time. Each token batch is a new acquisition, and say getting that 12-month discount is a real problem. Just figuring out what you're actually selling is a bit of a problem. Any comments there, Shane?
Yeah, I mean, definitely the airdrops can be a real pain, especially when they're of very small value. You frequently see these airdrops coming through of like 1 cent or 2 cent, and there's hundreds and hundreds of them, and they're quite pollutive to your transaction records. So yeah, keeping track of that's a real pain point. I think also the other point around your rug pulls and the staking income, that's really important. We've seen that kind of catch people off guard. Like when you're receiving the staking rewards, say you've deposited into a yield farm and you're earning staking rewards, and say you've earned some cake through PancakeSwap or some egg tokens or something, and they're $200 as you're receiving them, and then the market crashes, like that particular currency crashes afterwards, and maybe now it hasn't rug pulled, but it's only worth $2. The thing is, you've earned income tax, and then you could sell it and it's going to trigger a capital loss. You've got quite a lot of exposure there from the income tax. Yeah,
it doesn't make much sense, because you pay the income tax on it, and then you get a capital loss, and you can't use a capital loss on your income. Yeah. And there is no discretion in this. So if this happens to you, you're in for a bit of a world of pain. You may be able to settle with the ATO if it's a huge amount of money, but I wouldn't expect much sympathy, to be honest. Yeah. So yeah, I think that one's important, so that people realize the risk that they're exposing themselves to. Because say if you're receiving the staking rewards and you received $100,000 worth of income in staking rewards, that tax already realized at that point in time. Yep.
If you go and sell it for $20,000 in 6 months because the project tanked, you can only, like you were saying, forward that loss you're still going to be exposed for this financial year for that 100K income tax.
Yeah.
And that's that this is going to really catch some people off guard. They're not
exactly.
aware that, you know, when they receive, this is what I did. Like when I received the Uniswap airdrop, for example, I went and sold half of it immediately because I wasn't sure if it was going to tank or not. It went up 10x and I felt pretty stupid for it. But, you know, like you got to make that judgment call as to what's your actual exposure here, because you are exposed from a tax perspective as you receive those tokens.
Yeah. And I wouldn't expect sympathy either, unfortunately, just because the ATO is quite critical of investors in this space. If this happens to you, you probably need some help. Anyway, we're running out of time. So what I'm going to do is I'm going to run through quite quickly because I want to have time for questions at the end, because the questions are perhaps the funnest thing. Liquidity pools present a very strange issue. So a liquidity pool is pool is you get 2 tokens, you will exchange them on something on like Uniswap or one of the other ones, that's all I can think of right now, and you'll get something back called an LP token. So you put 2 cryptos in and you get 1 token back, which represents an equal value of both of those cryptos. You can then stake, it's probably not the right word. You can put the LP token in the liquidity pool where it will earn fees, and people will use the liquidity pool to do transactions much faster than finding actual buyers and sellers for tokens. They use the pool and it just helps. What you receive, those fees are basically going to be income. However, an issue that's been raised with me, which unfortunately I think is correct, is when you dispose of the 2 cryptos for 1 token, that's got to be a CGT event. I can't see a way around that, because it's a crypto to crypto transaction. Just because the LP token doesn't have a secondary market, it is a different asset. And the reason for that is really because there is this impermanent loss that happens if the underlying cryptocurrency is changing value. You can have it, you can get a different amount of crypto back out of the liquidity pool at the end of the day, depending on what happens. So you're not just putting it in a trust. You're not just giving someone the ownership and you keep beneficial ownership. You've actually disposed of it and got something different. And the ATO seems to be in agreement on that, but Shane and I are going to keep pushing them on that one. But I don't think we'll see much luck there. So there's lots of LP providers. Yeah, BlockFi, PancakeSwap, Aave, Uniswap, SushiSwap, all the food themed ones. If it's food themed, usually it means it's pretty good. That's certainly not financial advice. Yes, spoke about this. It shouldn't really have an impact if you are running a business of LP farming. But the trading stock rules, I'm sure, will be an absolute nightmare. I haven't actually thought about that one too much. Crypto mining. Mining, when we talk about mining, it's proof of work as the mechanism. Bitcoin and Ethereum are currently the only ones that really use proof of work, and Ethereum will stop doing it eventually, where you must solve puzzles and validate the blockchain transactions, all that sort of stuff. Mining is a cost-intensive activity. It's not as profitable as it used to be. You've got to buy a lot of equipment. You've got to spend a lot of money on electricity or solar panels or something like that. But mining itself, in the classic term, is very expensive and requires substantial capital, and you're pretty much always going to be running a business, unless you're doing it at very small scale, maybe a hobby. There's other methods, which is worth mentioning. Proof of stake is currently the biggest one. There's a few variations on that. And I was doing a bit of research, and there's also proof of activity, which I haven't come across much yet. And there's sort of proof of holding. So I've got some VeChain. I to much of my surprise, I got some VThor on my wallet randomly one day, and I figured out that's actually what happens. Mining crypto, you're either going to be running a business or you're going to have a hobby. You've got to pick one. If it's a very small scale, it's just going to be a hobby. The coins you receive are not income, but when you sell them, you'll pay CGT. That's not super common unless you're mining a little bit of, Raven coin on your laptop. Then you don't really have to declare it. But if you sell it later, you would have to declare it as a capital gain. There is no hobby exemption for capital gains. If you're carrying on a business, which is if you've got a few mining rigs, spend a bit of money on electricity, you receive that the coins you mine are income. And if you're running a business, you also get great deductions. So expenses, electricity, The instant asset write-off can also be available. So if you spend a heap of money on mining rigs, you can get all that as a tax deduction as well. And also losses as well can be available on revenue account to offset other income. But you shouldn't be having losses if you're running mining. Shouldn't be. We kind of went through this. I'm going to be a little bit faster. Bridging contracts. Now, this really did my head in. I think it did your head in too, Shane. Bridging is when you basically put a coin into a smart contract to get out a new coin. And the simplest example is when you have original Ethereum, put it in a bridging contract, and you'll get the ERC20 version of Ethereum. And then you can do stuff with that new token that you get out. And in that really basic example, you can then, stake it. You can do all sorts of stuff on the layer 2 networks, whereas original Ethereum you couldn't. And the issue that we've got is if you're putting one asset in to a smart contract and get something out, is that a CGT event? Is that a disposal and then reacquiring a new asset? Like a really basic thinking is that it is. But there's a few ATO rulings out there from the 90s, which obviously don't relate to crypto, but say that simply changing the rights attaching to an asset is not a CGT event. And that relates to shares being their right, removing dividend rights and things like that. But this hasn't really been thought through yet. This is one of the things that evolved in the DeFi summer, and we just don't know this yet. So me and Shane are trying to get clarity on this one. We're hoping that it's a no. There's some more serious, more significant changes, such as if you, put Ethereum into somewhere to get it wrapped and used on the Binance Smart Chain. That's a very significant change of the rights. I just don't know where the line is about what is it. Is it all a CGT event, or is only some of them, or what? So that's what we're trying to understand, and I'm sure we will report back to that somewhere. Last one, lucky last, crypto SMSFs. Surprisingly, you can invest in cryptos. There are some providers that allow trading, such as Independent Reserve, is the one I'm aware of, and there's a few others as well. You need to, if it's in an exchange, it's pretty easy to set it up to go. It's in the name of the fund. If you're doing DeFi or using cold wallets, you need legal documentation to acknowledge the ownership of those wallets, and you need to be super careful you're not sending funds to the wrong wallets, because it can cause you massive problems. And I've no doubt the ATO super fund people are going to jump up and down. They are under very strict laws. There's no discretion. If you accidentally misuse funds, even if you just put it straight back, you could be in for a world of pain. So be extra careful if you're having SMSF wallets. Do not mix them. There are lots of guidelines about valuing the crypto each year, which shouldn't be too much of a problem because you've got exchange data. And it doesn't fall within the related party transaction rules because it's not a security, which is interesting. Doesn't really help too much in most cases, though. You've got to remember that super funds are for retirement. They are to plan for your retirement. They are not to provide any other benefits to you until you are retiring. I think 60 or 67, whatever they've changed it to now. Interestingly, they can make a lump sum transfer at 67 via the crypto, via distribution of assets. However, if they're doing a pension, it has to be over time. CGT applies as usual. As I mentioned before, we get a 33% discount. And we're expecting people to be in this more. Now that we're seeing managed funds, now we're seeing index type products in this space. So expect SMSFs to invest more in crypto in the future. All right, I went over. What we're going to do is Shane's demo about how CryptoTaxCalculator works, and then we might return with some questions.
Thanks, Harrison. Yeah, definitely. I'll just be quick with the demo because I do want to have some time for the questions as well.
I've stopped sharing, so you're ready to go.
You guys see the screen?
Yep.
Yeah, great. Yeah, so just a couple of things I wanted to point out. Australian-based, obviously been working closely with Harrison to cover off the ATO tax rules. Our support's all based in Australia as well, so you can just give us a chat. Essentially, the idea of this platform is that rather than keeping track of everything in Excel sheets, etc., or on paper, you can actually just drag and drop your exchange data into the app. And you can also just add your public wallet addresses, and we'll pull in all that data from the blockchain. And we'll try to actually categorize that data based on what kind of smart contracts you've been interacting with, etc. So there's a lot to it, obviously, in the background. One major point is, the coverage. We cover all the Australian exchanges. We've got close relationships with all of them, but we cover over 400 different integrations, as well as all the kind of NFT and DeFi type of stuff, like the Uniswap exchanges. That's all covered. All you have to do for that stuff is just add in your public wallet address and we'll pull up all the data. The actual app itself looks something like this. So this would be the reports. You've got a dashboard. So you've got your overall balances. So that's kind of a side effect of doing all your accounting, is that you do actually have an accurate record and you can keep up to date with your balances. Factually, doing something, say you've traded on Binance, for example, you've got the options to import via CSV or sync via the API. If you've gone and then done some degen activity on PancakeSwap, you just add in your public wallet address. For the purpose of this demo, we've already added CoinSpot and a couple of ETH wallets here. And you can see here the transactions. So this actually comes with the free version of the software. You actually are able to see a full breakdown of each transaction and exactly how the capital gains were calculated and the rules that have been applied, as well as the different categories. So you can see here we've got an unknown category. So what's that flagging to us is that we don't know who this wallet is. We haven't yet imported it. So either, you're selling or you're sending it to your own wallet. If you were to import that wallet, then it would get automatically categorized as a transfer. So it's very important that you kind of focused on importing all your data, because the system gets smarter as you add more data. We've got, more to work off. And then you review your transactions. That's the next step. And I'll just show you how complex some of these calculations get. I've got some example data here. Let me just pull up this particular transaction. So we could see here we're selling USDC for $0, and there's a loss of $86. And you can see the breakdown. We've got some unknown ins, which means that we haven't yet categorized this as a buy, or we don't have the complete information with this example. But you've also got the fee itself, which is a disposal, because this is on Uniswap. So you're paying a gas fee. So 0.02 gas fee. So it's saying here, well, look, we bought the ETH for $961 and we sold it for $2,242. So you've actually got a gain on the gas fee, right? Which offsets your loss. So it's not $118 loss here. It's an $86 loss. So, you could see if you're actually transacting on the blockchain, it gets really complex really fast, and it's pretty much impossible to keep track of it. It makes it even harder when, a lot of the activity that goes on in cryptocurrency gets broken up into multiple transactions. So the transaction counts can get really high. If you're staking ETH on ETH 2.0, I believe the payout's going to be every 6 minutes. So you can imagine how many transactions that racks up. So we've been very considerate around that with the pricing. Our plans cover very high transaction counts. And once you've reviewed all your transactions, you've cleared all the warnings up here and everything's reconciling, then you can generate reports. You can generate reports for any financial year. It's all covered under the one pricing plan. It's a subscription service. So if you've got 4 or 5 years worth of cryptocurrency taxes to catch up on, that's all covered. And you've got different inventory methods as well, which Harrison could probably talk more about in the FAQ. And you've got different reports here. You can manipulate these reports. You can actually, sort by largest losses, like by absolute value. And you can download these reports and share them with your accountant. We've also got a full accountant suite. So if you are an accountant, you can sign up, give us a bell, we'll get you set up on the accountant suite. We've even got an enterprise suite. So you can actually talk to your accountant about having them join the platform, and you can actually get managed, reconcile the transactions with them. They can invite you into the platform, and you can actually work through the transactions alongside your accountant as well. That's about it. I want to kind of just jump straight into the questions, I suppose. Just trying to work out how to stop sharing here.
Thanks, Shane and Harrison. That was awesome. The product looks very different from our last demo. I think you've been really busy this last year. It's looking amazing, and there's a lot of new features, right?
Yeah, absolutely. So, I mean, I think we scaled up, as a bear market when I first started off the product. Since then, my co-founder joined, since we last spoke, Adriana, and then we've scaled up the team. I think it's almost 20 people at the moment. So we're actually actively hiring. If you are a good software engineer, definitely reach out. We've also got some roles for customer support, marketing even. So definitely, if you're into crypto and you're looking for a role, flick over your resume. Yeah.
Awesome. All right, so let's jump right into the questions. And I will start with one from Rob Allen, which was at the very beginning of the talk. Please also include NFTs in the tax treatment. And that's important because we get gifted NFTs all the time. And how does that apply? Because an NFT that today may be worth like half an ether, in 10 weeks time could be 10 times that. And how do we report those?
So is this just general buying and selling of NFTs? Is that, yeah, I'll start with that.
And also when it's a gift.
When it's a gift, okay.
Yeah, it's not a capital gains event. Tax
yeah, it is. That's right. So when you're buying and selling, when you buy an NFT, say it's half an ETH, that's your cost base, and then when you sell it, you'll have a capital gain. It's in that sense treated like any other token, like any other CGT event. It's not particularly special. What's a little bit different about it is obviously they're all unique. So they've got, a different kind of inherent value than when you buy a protocol or a token or something like that. When you gift it, it depends greatly what you're gifting it for. So say me and Shane are good mates, and he decides to send me a CryptoPunk worth $10 million, which is very nice of him. Say he bought it for $1 million. If he just did a gift and said, here you go, this is yours, lucky you, there are some special rules called the market value substitution rule, which can apply to say, well, no, you didn't gift it, receive no money, and get a loss. In fact, what we're going to say is we deem that you've received market value for it. Actually valuing these things can be difficult at certain points in time, depending on the project. But it's kind of like you've just got to do your best. I don't know of any valuers yet who will value NFTs, but I have no doubt that field will blossom one day.
All right, moving on to a question from Jess Telford about record keeping. What happens if your records are no longer available? For example, if an exchange you used to purchase crypto has gone offline, are there any alternative ways to keep a record?
Maybe you start with that one, Shane.
Yeah, yeah. Welcome to the nightmare, I guess. It does happen all too often. I guess that's one of the reasons to be keeping your records up to date on, say, a monthly basis rather than just thinking about it in the financial year. If you are in this situation where you've got missing records, maybe Harrison, I'll put that on to you. What's the approach? It's
not good news. So it's on you to keep records. It's your responsibility. It's not the ATO's job to prove things. And that's part of, it's kind of necessary for an efficient tax system. You can't make the ATO do all the work for you. And it does seem very unfair, but it's kind of the way it has to be. Look, if that did happen to you and you're trying to be compliant and you have other records, the ATO will often accept those in substitution. They have a power to say, well, you don't have the records, but we will accept what you've got. So say you had $100,000 on there and you can show that. and then that exchange is gone, it was a rug pull, everything's gone, they'll probably let you claim that capital loss. You're not going to have a transaction showing it, but you'll practically be able to say, look, I was essentially scammed, and show that. And but you can't really depend on it. It's about giving it your best. And yeah, just try to keep the records. I'm sorry, it's the best advice I can give you.
All right, so for everybody who haven't been keeping their records, go and do that right now. Download all your records and keep them safe. You can also use Shane's product and he will keep them safe for you. Okay, CGT event. What happens when you transfer crypto? For example, moving one Bitcoin from a cold wallet to a hot wallet that you want on both?
Interesting question.
Sorry, I was just going to clarify. Are there any tax implications?
Yeah, yeah, of course. Of course, that's why we're here today, I guess. So when I say CGT of an A1, it doesn't happen if there is not a change of beneficial ownership. If I'm picking up this glass from my right hand and moving it to my left hand, that's not a CGT event. Like, ownership has changed because physically this hand has it. It's the same with the wallets. If it's your wallet that you're moving things around to, there's no CGT of an A1. It's not a problem. And that applies to, on and off exchanges, because it's still, well, it is your crypto for CGT purposes, despite custodial risk. But moving between wallets is not a problem we have, thankfully. Any more to add, Shane?
No, I think just with the product itself, yeah, that's one of the things. Like, if you import both your hot wallet and your cold wallet, you've got the outgoing transaction from one wallet, the receiving transaction from the other, and we can pair that up. You do need to consider capital gains on the fee that you've disposed of to pay for the transaction on the blockchain. That's something that's sometimes overlooked. Yeah.
Is that pretty negligible though? Or like, is there a chance that, say, while you're trying to transfer, there's a massive volatility and Dogecoin goes up by 10x? What happens? Is that it's not really your fault? I guess is that a loss if you've transferred yourself Dogecoin at a time when it was worth less and then it massively went up because of volatile markets? Like, are there any kind of crazy events like that have popped up?
Yeah, I'd say, I've definitely been one to panic sell at a high volatility point in the market. I'd pay like, $200 for gas fees. That's a disposal.
So those are taxable.
Well, you'd expect so. If I've bought the ETH for $30 and it's now $3,000 and I'm selling $200 of it to power a computer, a computing system on the internet, then yeah.
If you're transferring it to your own wallet though, it's an interesting question. Like, let's say you're just copying a big fee, but to transfer it to yourself, that's still taxable even though it's going to you.
So if I'm moving from
the ETH is taxable, like the gas fee, it could be a gain or loss.
Right.
Where does that go? I think that one's pretty clear. That one goes into the cost base of that coin. What's not clear, and what me and Shane are still grappling with, is when you sell and buy crypto and you've got to pay gas, where does it go in the cost base? And just for clarity, we didn't really cover this, but the cost base does reduce your capital gain. So you add, so that the capital gain is a difference between your cost base and your capital proceeds. And if your cost base goes up, there's obviously less gain. But yeah, it's kind of like when you do one thing, you're actually doing two things, which is why the record keeping is just an absolute nightmare if you do it yourself.
Yeah, so there's the potentially, I think what Harrison's saying, there's the total value of the gas fee could be added to your cost basis, where on your cost basis isn't totally clear.
Yeah.
You spent $200 in gas, but say if you bought ETH for $30 and sold it at a value of, $3,000 per ETH, and the total value is 200, that total value gets added to your cost base. But there's also a gain between when you purchased and the total value that you sell it for. And that difference is also needs to be considered. So there's multiple things here. There's like a layer, there's a cobweb kind of scenario here. Yeah.
Yeah. It never ends, unfortunately. The complexity here.
All right, next question from Mark Vozo. He says, question for Harrison. Let's say I lend my crypto to a family member, meaning I expect to have the crypto returned to me in the future. Hence, the ownership has not changed. Is this a CGT event?
Loaning property. Think about this in terms of other assets. You can't really do it with anything else. So this really hasn't come up in the context of CGT before. If I'm loaning, if I'm loaning a house out, not a lease, but I'm giving it to you, but you have to give it back to me later, there is a change of beneficial ownership. If they're going to, because they're going to benefit from it. So like a loan in that instance is I'm loaning Shane a house and say he has to pay me 2% interest on the value. And then Shane can lease it to whoever he wants, which is different to me just saying to Shane, you can live there, but it's my house. And these sorts of legal qualifications are really important to understanding whether there's a CGT event or when there's not. If you're loaning, if I'm giving Shane, 100 cake tokens so he can stake it, and then he agrees to give it back to me one day, that's scarily looking like a change of beneficial ownership, unfortunately. But we can structure it in a different way to make it not like that. You know what I mean? I'm talking even though you can't respond. But yeah, like it's an asset we can do stuff with that we couldn't do before, which raises these very strange questions and yields strange outcomes, kind of like that. Loaning property doesn't really happen in the real world. You get a right to use, but if I'm loaning it as a right to use it, then it's not a loan, it's a lease, if that makes sense.
Yeah, it does make sense. And I guess the takeaway here is that if you're doing something where you don't know what's going to happen, seek real advice, because you might be caught up in a situation that's going to be very hard to mediate later on. All right, yeah. Next question. Vivek Jindal asks, I think this one is for Shane. How does your platform help someone who has moved from abroad and the date of entry price applies?
Yeah, so I mean, that's a challenging one. You'd be able to, we do facilitate, the ability to upload manual CSVs, and you can kind of manually manipulate your transaction history to represent those changes in the cost basis from when you arrived. But obviously it's not as automated as you'd like, because it's quite an edge case in that scenario.
All right, thank you. We're getting very close to the end. And let me just say this, if we don't get to cover all the questions, I will forward the remaining ones to these amazing people and I'll ask them to answer and I'll get back to everyone. Question from Jess again, carrying on a business with a significant volume. Let's say if he bought 10 BTCs in 2010, held it personally, then sold it in 2021. Is that considered significant volume? What are the boundaries there?
I'll shoot at once for me. The volume is more about the volume of transactions, not about the sheer amount of capital. As I sort of said, the sheer amount of capital is one factor, but if that's all you've got, that's not enough to say you're carrying on a business. There's one case which is not related to crypto. It's related to someone buying a heap of shares in a listed company, was very active in protecting them and voting and doing all this stuff. And he was carrying on a business because of the way he dealt with it. But if you just bought and held Bitcoin for 11 years, in which case, congratulations on your lots of money. Yeah, all you've done is realize the intrinsic value in the Bitcoin. You just bought something and hold it. If that's all you're doing, you're not in business. If you were buying and selling all the time in that whole period, you would be, but it sounds like you're not in business to me.
Okay, so how about sole traders who operate in the crypto space and are, let's say, getting paid in crypto all the time, and then they may use part of that to pay their expenses, and they may hold on to some part of that to, for future gains.
Yep.
But they are also paying income tax at the time that they issue their invoice and whatnot. So that's a complicated edge case, I think.
It is. And one I dealt with recently, actually, a fellow that I was working with, he works for a DAO, and he gets paid in the governance token for the DAO. And the governance token is relatively stable. So how it works is, well, there's a few ways for it to work. Basically, he would sell some of it because obviously if the token crashed, he pays income tax when he receives it. That bit's not an issue. And then if it crashes, he'd get a capital loss. There is some thought out there that tokens that you acquire like that to use for your personal bills and things like that is a personal use asset because it's held mainly for your personal use. But there's another school of thought, which I kind of side with, that says, well, no, it's not a personal use asset, just like how money isn't a personal use asset, because you don't use money. You spend money to buy things that you use. And the language of the law is very clear about what are you using the asset for? All I can use the asset for is to realize economic value and vote and all sorts of stuff on the governance system for this fellow. So you need to be aware that when it comes in, it's accessible, and make sure that you're planning for those tax obligations in case the worst does happen. But it is quite a popular way to pay contractors and staff at a DAO. The one that I worked with, everyone was paid in the governance token. That was it. There was no cash at all, which was interesting. A lot of them are a mixture. But yeah, it's complicated and we don't know the answers. I'm sorry about that. We will, I'm sure, at some point, because this is becoming a bigger issue.
All right, I think I'm gonna make this last question as we're coming up to 1 hour. If a CGT event for the conversion of crypto via smart contracts through bridging, query whether cost base for new crypto is the value of the original crypto at the date of the conversion? I don't know if I understand this question.
That's all right, I get it.
Okay. Yeah.
Sure.
That's all that matters.
So we're talking about the wrapped token. So in this instance, say we bought some Bitcoin many years ago, and when it was $1,000, and now it's at 50 grand, and then I put it in a bridging contract to get wrapped Bitcoin, and I'm using it on some other network. The question is, what's the cost base of that wrapped token? And it's the first element of the cost base is, what did you pay to acquire it? What you paid to acquire it was the Bitcoin that you put into the smart contract. So the Bitcoin, it was worth 50 grand on that day. So you have a cost base of 50 grand. Now, what we're not sure of, just to walk this back a bit, is whether using that bridging contract is a CGT event. Because if it's not, then that wrapped token will carry forward that $1,000 cost base, or it will carry a zero cost base. One of the two. It won't carry the 50 grand. So this is an important question, and it does come up quite a bit, and there is not much information yet. So we don't know where it's going to land, but if it is taxable, you'll get that market value cost base.
Okay, that makes sense. All right. That's it for today. Thanks everyone for watching. Thanks for your questions. Thanks Shane and Harrison and Kaya for the moderation. How do people find you guys?
You go first, Shane. Where do we find you?
Yes, I think at the bottom of this video, there's going to be something in the description, but essentially it's CryptoTaxCalculator.io. It's just a bit of an independent domain name there, but it's .io. We are Australian based, but
that is there at the video description. I also will link the slides on the video description as well prior to this. I know Amy was asking for it on the chat as well. Thank you, Amy. All right, thanks everybody. We'll see you at the
it's also
next
me.
one.
Where do you find me?
Oh, sorry. Where do we find you, Harrison?
So you can find me in two places. You can find me at Chamberlain's Law Firm, which you'll be able to find me online if you Google me, I think. And you'll also find me on TikTok, where I talk about all sorts of crypto stuff as well, which is Harry Dale Tax Talk. We talk crypto tax there all the time. It's very niche, but we have fun.
Sounds like fun.
That's awesome. Thank you.
Thank you.
All right, Kaya, we can find you at the next Blockchain Professionals Meetup. And? Yes,
and on Twitter at Myers Kaya. You can find Bitscore, my company, at 000 is not the area code. I don't know why I had a phone number in my head. You can find us at https://bits-core.com.
Awesome.
Yeah, it's pretty cool. Adri, where can we find you?
Oh, you can find me here in this channel. You can find me on Twitter. I'm at abellotti, and I'm on LinkedIn. Please say hi, drop me a line. I'm always willing to chat.
Awesome.
All right. Thanks, everyone.
Thanks all. Cheers.
Thanks for putting this together, Adriana.
Oh, no worries, guys. My pleasure.